When it comes to the world of cryptocurrency, logic doesn't always rule the day. Emotions do. Fear, greed, excitement, and even hype can send prices soaring or crashing within hours. Unlike traditional markets, where institutional stability and long-term fundamentals often dominate, crypto is driven heavily by human psychology. Every tweet, every rumor, and every viral post can spark a wave of emotional reactions that ripple across the entire market. This is why traders often say the market is driven by sentiment, because behind every green or red candle on the chart are real people, and people are emotional beings. Think about it. When Bitcoin starts climbing fast, the dominant emotion becomes greed. Investors rush in, fearing they'll miss the next big run, pushing prices even higher. But when the market starts to fall, that same crowd turns fearful, selling in panic and deepening the crash. These cycles of euphoria and fear repeat over and over, shaping the heartbeat of the crypto market. It's not just about numbers, it's about mood, tone, and perception. This is where sentiment analysis comes in, a tool designed to measure the emotional pulse of the market. Instead of looking at price charts or technical indicators, sentiment analysis examines what people are saying and how they feel about a cryptocurrency. It collects data from millions of online conversations on platforms like X, formerly Twitter, Reddit, Telegram, and news sites, and analyzes whether the overall mood is positive, negative, or neutral. The result gives traders and investors a real-time snapshot of how the crowd is thinking and feeling. In essence, sentiment analysis acts like a market mood detector. It helps us understand not just what is happening, but why it's happening, whether optimism, fear, or hype is driving the moves. And as we'll soon discover, mastering this emotional pulse can give you a powerful edge in navigating crypto's unpredictable waters. And if this is your first time here, welcome to Crypto Education Zone, where we break down the crypto market in simple, practical ways to help you invest smarter. So stick around, because by the end of this video, you'll understand what sentiment analysis is, why it matters in the crypto world, and how it helps you read the emotions driving market movements, giving you the confidence to stay one step ahead of the crowd. Sentiment analysis, in the context of cryptocurrency, is the process of evaluating the collective emotions and opinions of market participants to gauge how they feel about a specific coin, project, or the market as a whole. In simpler terms, it's like taking the market's emotional temperature, finding out whether people are feeling optimistic, fearful, or indifferent about crypto at any given time. While technical analysis focuses on charts and price patterns, and fundamental analysis examines project strength, sentiment analysis focuses on how people think and feel, the emotional force that often triggers buying and selling decisions. At its core, sentiment analysis categorizes market mood into three broad types: positive, negative, and neutral sentiment. When sentiment is positive, it means investors are optimistic. They believe prices will rise and confidence is high. This often happens during bull runs or after good news, like a major partnership, exchange listing, or regulatory approval. For instance, when BlackRock announced its Bitcoin ETF application, positive sentiment flooded social media, fueling a surge in Bitcoin's price as excitement spread. On the other hand, negative sentiment arises when fear, uncertainty, or doubt, often referred to as FUD, dominates the conversation. Investors become cautious, confidence drops, and many start selling to avoid losses. For instance, when China announced its crypto mining bans, or when an exchange like FTX collapsed, fear spread rapidly across platforms like Twitter and Reddit, leading to widespread panic and market sell-offs. Then there's neutral sentiment, which occurs when the market shows balance, neither overly bullish nor bearish. During these times, traders may be waiting for clarity, consolidation, or a trigger that could swing sentiment in either direction. It's a calm before the storm scenario, where uncertainty and observation dominate. What makes sentiment analysis so fascinating is that it doesn't just observe emotions, it can also predict movements. For example, if positive discussions about Ethereum suddenly surge across social media while prices remain stable, it could signal upcoming bullish momentum. Similarly, a sudden spike in negative sentiment might warn of potential sell pressure before charts even react. The power of sentiment lies in its reflection of crowd behavior, the same behavior that fuels bubbles and crashes. When too many people feel overly confident, markets can overheat and form tops. When fear dominates, prices can drop below their real value. Understanding these emotional extremes helps smart investors act rationally, while others react emotionally. Having understood what sentiment analysis means and how emotions shape crypto price movements, the next step is to explore how it actually works, how data is collected, analyzed, and transformed into actionable insights that traders and investors can use to make better decisions. Sentiment analysis in the crypto world works by collecting and analyzing massive amounts of public data to determine the overall mood or emotion surrounding a particular asset or the market in general. Since cryptocurrencies are decentralized and heavily influenced by public opinion, most of the relevant sentiment data comes from open digital spaces, places where people share their thoughts, fears, and excitement in real time. These data sources include social media platforms, news outlets, crypto forums, and specialized analytics tools that track and interpret the emotional tone of market chatter. Social media is one of the most powerful sentiment indicators in crypto. Platforms like X, formerly Twitter, Reddit, Telegram, and YouTube often shape market psychology before price movements even begin. When a coin starts trending on Twitter or becomes the subject of heated debates in Reddit communities like r/cryptocurrency, it often leads to increased volatility. For example, when Elon Musk tweeted about Dogecoin in 2021, the token's price skyrocketed almost instantly. That single tweet wasn't a technical event or a fundamental change. It was a pure sentiment shift driven by social influence. Similarly, panic-driven posts about hacks, regulations, or exchange issues can cause prices to drop sharply even before the facts are fully verified. Next are crypto news outlets and forums such as CoinDesk, Cointelegraph, and Bitcoin Talk. Positive headlines like institutional investors increasing Bitcoin holdings can boost confidence, while negative stories, such as exchange faces liquidity crisis, can send shockwaves through the market. Forums, on the other hand, capture the grassroots sentiment, the unfiltered opinions of everyday traders and investors, giving analysts a clearer sense of what the crowd is thinking. To process all this information efficiently, analysts rely on AI and natural language processing tools. These technologies can scan thousands of posts, articles, and comments every minute, identifying emotional words, tone, and recurring keywords. For instance, if a large portion of social media posts about Ethereum include positive words like bullish, breakout, or buy, the system interprets this as a rise in positive sentiment. Conversely, words like crash, dump, or scam indicate a negative tone. These algorithms then assign numerical values to the overall sentiment, producing what's often referred to as a sentiment score, typically ranging from highly bearish to highly bullish. One of the most popular tools for summarizing this emotional data is the Crypto Fear and Greed Index. This index simplifies market sentiment into a single number between 0 and 100, where lower numbers represent extreme fear and higher ones indicate highly greed. For example, during a market crash, the index might show a value of 10, signaling widespread panic and potential buying opportunities for contrarian investors. Conversely, during euphoric bull markets, it might rise to 90 or above, suggesting overconfidence and a risk of correction. The index factors in multiple data points, such as volatility, social media trends, trading volume, and Google search activity, making it one of the most trusted sentiment indicators among traders. In essence, sentiment analysis transforms human emotion into measurable data. It bridges the gap between psychology and technology, helping investors visualize the emotional flow that drives price action. However, gathering and understanding sentiment data is just one piece of the puzzle. The real value lies in why it matters and how these emotions directly affect the market's ups and downs, which is exactly what we'll explore next. Sentiment matters in crypto because emotions are one of the strongest forces driving market behavior. Unlike traditional financial markets that are heavily influenced by institutions and long-established fundamentals, the crypto market is still largely dominated by retail investors, ordinary people who make decisions based on fear, excitement, and social influence rather than deep analysis. This makes crypto prices incredibly sensitive to the collective mood of the crowd. When sentiment turns positive, investors feel confident and optimistic, leading to more buying activity and higher prices. You'll see this reflected in euphoric social media posts, rising trading volumes, and bold predictions about going to the moon. In these periods, even weak projects with little utility can surge, fueled purely by hype and momentum. A perfect example of this was the meme coin frenzy of 2021. Coins like Dogecoin and Shiba Inu skyrocketed, not because of revolutionary technology, but because communities rallied behind them, amplified by viral memes and celebrity endorsements. Tweets from influencers, especially figures like Elon Musk, had the power to move billions of dollars in market capitalization within minutes. Every time Musk posted something playful about Dogecoin, traders rushed to buy, creating massive short-term spikes. This wasn't logic, it was sentiment in action. On the other hand, negative sentiment can trigger the opposite effect. Fear spreads faster than excitement in financial markets, and crypto is no exception. When rumors of government bans, exchange hacks, or massive sell-offs hit social media, panic can set in almost instantly. Investors start dumping assets, leading to cascading price declines. For instance, when China announced its crypto mining ban in 2021, Bitcoin and other major coins saw sharp drops, even though the fundamentals of Bitcoin's technology hadn't changed. The sell-off was a reaction to fear, not fact. Sometimes neutral sentiment, when the market is uncertain or indecisive, can lead to sideways movement or low volatility. This happens when traders are waiting for new information or major events before committing to a direction. These quiet periods often precede big moves because they represent a buildup of tension. Another vivid example of sentiment at work is during market crashes. In bear markets, fear dominates the narrative. Negative news stories, alarming predictions, and emotional posts flood the internet. People start believing that crypto is dead, just as they did during the 2018 and 2022 crashes. Ironically, these fearful moments often mark the best buying opportunities for long-term investors who understand the emotional nature of markets. As the saying goes, be fearful when others are greedy, and greedy when others are fearful. The importance of sentiment lies in its ability to shape short-term market direction even when fundamentals stay constant. A strong project can temporarily lose value if the overall sentiment turns bearish, while a weak coin can soar during hype-driven mania. Smart investors recognize this dynamic and use sentiment analysis to gauge the crowd's mood, allowing them to anticipate volatility, avoid emotional traps, and make more rational decisions. Understanding how emotions move markets leads us naturally to the next question. How can investors use this knowledge strategically? To do that, we need to see how sentiment analysis fits together with other forms of analysis, like technical and fundamental, to build a balanced investment approach. For investors, sentiment analysis isn't just about knowing how people feel, it's about learning how to act intelligently based on those emotions. In the crypto market, where price action can swing wildly on emotion-driven reactions, mastering sentiment analysis can be the difference between buying into hype and seizing real opportunity. The smartest investors don't rely on sentiment alone. They combine it with technical and fundamental analysis to create a well-rounded strategy that balances emotion, logic, and data. Here's how it works in practice. Step 1. Combine sentiment with fundamental analysis, FA. Fundamental analysis helps you understand what a project is truly worth, its technology, use case, team, and long-term potential. Sentiment analysis, on the other hand, tells you how the market feels about it right now. When both align, meaning a strong project also has positive sentiment, it can signal a high-confidence buying opportunity. For example, if you've researched a DeFi project with solid fundamentals and notice growing optimism on social media and crypto forums, it might indicate rising adoption and market recognition. Conversely, if sentiment is euphoric but the fundamentals are weak, that's a red flag that the price might be inflated by hype. Step 2. Combine sentiment with technical analysis, TA. Technical analysis focuses on price patterns, volume, and chart behavior. When you layer sentiment data on top of TA, it helps confirm or challenge what the charts are saying. For instance, if technical indicators show a breakout forming and sentiment across the community is turning bullish, it strengthens the case for upward momentum. But if sentiment turns extremely positive while charts show overbought signals, it might suggest a possible market top, a moment when everyone is too confident and smart investors prepare to take profits. Step 3. Learn to read market trends and spot hype. Social media platforms like X, formerly Twitter, Reddit, and Telegram are gold mines for gauging sentiment, but they're also full of noise. A skilled investor learns to filter information carefully. When a topic suddenly starts trending or influencers begin pushing a coin aggressively, it's often a sign of short-term hype. Real sentiment shifts are usually gradual and supported by organic discussion, rising engagement, and increased on-chain activity. Before jumping into a trending token, check whether its momentum is backed by genuine community growth or just coordinated promotion. Step 5. Monitor sentiment indicators and tools. Use analytics platforms that track public emotions at scale. Tools like the Crypto Fear and Greed Index, Lunar Crush, Santiment, and Glassnode can help you gauge crowd psychology in real time. For example, when the Fear and Greed Index shows extreme fear, it often means the market is oversold and may soon rebound. When it shows extreme greed, it's a warning sign that prices could correct soon. Think of these indicators as emotional thermometers for the crypto world. Step 6. Stay emotionally neutral. The real power of sentiment analysis lies not just in observing others' emotions, but also in controlling your own. When everyone is panicking, it's easy to join the herd and sell too soon. When everyone is euphoric, the temptation to FOMO, fear of missing out, into overvalued coins is strong. But the best investors do the opposite. They stay grounded, patient, and objective, using sentiment data to anticipate rather than react to crowd behavior. In essence, using sentiment analysis as an investor is about reading the emotional waves of the market while steering your own ship steadily through them. You let the crowd show you where the extremes are, where fear and greed dominate, and use that to make smarter, calmer decisions. Now that we understand how to apply sentiment analysis effectively, it's important to remember that no tool is perfect. Just as with fundamental analysis, sentiment analysis has its limitations, from manipulated data to false hype, and knowing these weaknesses is key to using it wisely. Let's explore those next. While sentiment analysis is a powerful tool for understanding crypto market psychology, it comes with important limitations that every investor needs to recognize. In a space as fast-paced and unregulated as cryptocurrency, not all signals are genuine. and failing to filter out noise can easily lead to misleading conclusions. The truth is, sentiment can be manipulated, distorted, or even artificially generated, and if you're not careful, you might end up reacting to fake emotions instead of real market shifts. One major limitation is manipulated hype. In the crypto world, it's common for influencers, groups, or even entire communities to coordinate efforts that artificially inflate excitement around a token. This is often done to drive up prices temporarily so early holders can sell at a profit, a strategy known as a pump and dump. For example, a new meme coin might suddenly trend on X, formerly Twitter, or Telegram, with posts claiming it's the next 100x gem. In reality, this excitement might be orchestrated by insiders who own large amounts of the token. Once enough retail investors buy in, these insiders dump their holdings, causing the price to crash. If your sentiment analysis relies solely on social buzz, you might misinterpret this temporary hype as genuine market optimism. Another limitation is fake news and misinformation. The crypto industry thrives on speculation, and rumors spread fast. A single misleading headline like, "A major exchange is insolvent," or "A government just banned Bitcoin," can cause panic selling within minutes. Even when the information later turns out to be false, the damage is often already done. Similarly, exaggerated or overly optimistic news can create false bullish sentiment. That's why it's critical to verify the credibility of news sources and cross-check information before making investment decisions based on market mood. A third limitation is bot-driven chatter. Many social media accounts and forums that appear to represent community sentiment are actually automated bots or paid shills designed to manipulate perception. These bots can flood platforms with repetitive messages, positive hashtags, and fake engagement to make a project look more popular than it really is. For instance, a token might suddenly see a huge spike in mentions and likes, but if most of that activity comes from bots, it doesn't reflect genuine investor interest. Sentiment analysis tools that don't filter out spam or bot data can easily mistake this noise for authentic sentiment, leading to inaccurate readings. Additionally, context and sarcasm can distort automated analysis. AI-driven tools often struggle to understand nuance, irony, or regional slang. A tweet saying, "This project is going to the moon," might be classified as positive, even though it's clearly negative. Similarly, jokes, memes, and internet humor, common in crypto culture, can confuse algorithms, skewing sentiment results. Lastly, sentiment changes rapidly, and timing is crucial. By the time you detect a shift in crowd emotion, the price may have already moved. Crypto markets react in real time to social signals, so relying on delayed sentiment data can lead to chasing trends rather than predicting them. In short, sentiment analysis is a valuable lens for understanding market psychology, but it's not foolproof. It's most effective when used alongside other tools, like fundamental analysis for long-term value and technical analysis for price patterns. The goal isn't to blindly trust public emotion, but to interpret it wisely, separating manipulation from genuine market insights. Now that we've covered both the power and the pitfalls of sentiment analysis, let's bring everything together with a clear takeaway on why mastering this tool is essential for navigating the emotional tides of the crypto market and how it can make you a more confident, disciplined investor. In the end, sentiment analysis reminds us that crypto isn't just about numbers, charts, and algorithms. It's about people. Every trade, every surge, and every crash begins with emotion. Greed, fear, hope, and uncertainty all shape how investors behave, and understanding that emotional pulse gives you a huge advantage. When you can read market sentiment, you're not reacting blindly to price swings. You're interpreting the mood that drives them. Throughout this video, we've seen how sentiment analysis works as the bridge between data and psychology. It helps you detect the waves of optimism or panic that move markets before they fully show up in prices. By tracking how investors feel, you can make more strategic choices about when to buy, when to hold, and when to stay out. We also explored how it complements other forms of analysis. Technical analysis shows you the what, fundamental analysis shows you the why, and sentiment analysis helps you understand the how people react to those changes. Together, they give you a 360-degree view of the market, empowering you to invest with confidence rather than emotion. But, as we discussed, sentiment isn't always straightforward. It can be distorted by hype, fake news, or bots. The key is to approach it critically. Use it as a guide, not a guarantee. The best investors don't get lost in the noise. They use sentiment analysis to stay grounded, anticipate shifts, and recognize when the crowd is about to change direction. At its core, understanding sentiment helps you stay rational when others panic and calm when others chase hype. It's what separates emotional traders from disciplined investors. In a market as volatile as crypto, that mindset can make all the difference between short-term reaction and long-term success. If you found this explanation helpful, don't forget to like this video, subscribe to Crypto Education Zone, and turn on the notification bell so you never miss an update. Here at CEZ, we break down crypto concepts in simple, practical ways to help you make smarter decisions and grow as an investor. Remember, in the world of crypto, knowledge isn't just power, it's your greatest edge. Keep learning, keep questioning, and keep building your conviction.